right now. The single number professional investors use to tell whether the stock market is expensive or cheap sits at 40.6. It's called the Shiller CAPE ratio. And in 145 years of recorded market history, it has only been higher exactly one time before. Every desk on Wall Street can see this number. Almost nobody is talking about what happened the 2 times it got anywhere close. This isn't a prediction, it's a pattern. And today would be the 3rd time. This exact ratio, at this exact level, has shown up on a chart only twice before in American market history. Both times, within a year or two, the worst stock market crashes of their generation followed, wiping out fortunes, pensions, and companies that had existed for decades. Both times, almost nobody watching the number believed it applied to them. Neither crash arrived with a warning label. Both hit while the market was celebrating. By the end of this video, you'll see exactly what happened, in real numbers, after the only 2 times in history this ratio reached today's level. You'll also see a second number, one almost nobody puts on the same chart as this one, that made both of those crashes hit far harder than the valuation ratio alone would have predicted. It's still climbing right now.
So is 40.6 actually dangerous? Or is it just a big number that sounds scary on its own? Put it next to history and the picture gets a lot clearer. Today's reading sits above the level recorded in September 1929. Just a few points short of the all-time record set in December 1999, and more than double the 145-year average investors have paid for $1 of company earnings across every boom, war, recession, and recovery in between. There have only ever been 2 moments that measured higher than where the market sits today.
This isn't an ordinary price-to-earnings ratio, and that matters. It takes today's stock prices and divides them by 10 years of average. Inflation-adjusted company earnings, not just the most recent 12 months. That's deliberate. A single great year, or a single terrible one, can make a normal ratio look misleading. Averaging a full decade smooths that out, which is exactly why economists use this version to compare valuations across completely different eras of the economy. One bad year can spike a normal ratio for no real reason. This version ignores that noise.
The first time this ratio ever flagged territory like today's was September 1929, when it hit 32.6. At that moment, the Dow Jones Industrial Average stood at 381 points, and the country's biggest newspapers were writing about a new, permanently high plateau in stock prices, the idea that valuations simply didn't apply anymore. Within 3 years, that plateau, and most of the wealth built on top of it, had vanished from the chart entirely. The decade behind, it had already delivered easy credit and borrowed money buying that pushed prices past what the economy could support.
Here's exactly how much vanished. From its September 1929 peak to its lowest point in July 1932. The Dow Jones Industrial Average lost 89% of its value. Savings accounts, pensions, and family businesses that had been quietly converted into stock certificates during the boom went down with it. And this was only the first time in a century and a half that this ratio ever flagged this level of danger. For a family that had put its savings in at the top, that was almost nothing left to rebuild from. The second time was December 1999, when the ratio hit an all-time high of 44.19, a level it has never reached again since, before or after. 3 months later. In March 2000, the Nasdaq Composite peaked at just over 5,000 points, carried by a wave of companies that promised to reinvent the entire economy. By October 2002, that index had collapsed all the way down to 1,140. Many of those companies had gone public on the promise alone, without $1 of revenue. That's a 77% collapse in the index that carried the biggest technology names of the era. Some of those companies had never turned a profit and disappeared completely. Others were real, growing businesses that got dragged down anyway, simply for sharing a sector with the ones that failed. The ratio had already told anyone watching that valuations had detached from what the underlying businesses could actually support. The lesson wasn't that the technology was bad. It was that price still mattered. Both of those crashes shared something the valuation ratio itself never measured directly. How much of the entire stock market's value depended on a small handful of companies. When those companies wobbled, they didn't just fall on their own, they dragged the whole index down with them, because the index itself was really just a bet on a few names wearing a broader disguise. Today, that concentration number is bigger than it was in either of those 2 moments. A market built on a handful of giants can look calm while hiding far more risk underneath. 7 companies, Apple, Microsoft, Nvidia, Alphabet, Amazon, Meta, and Tesla, now make up 31.5% of the entire value of the S&P 500. That means roughly a third of America's flagship stock index now rises and falls on the earnings calls of just 7 boardrooms. This is the second number. The one almost nobody puts next to the valuation ratio, and it's a very different market structure than either 1929 or 2000 ever had. None of these 7 companies were this dominant in 1929. And few were even public by 2000. Here's the honest part of this story. This ratio has flagged exactly 2 dates in 145 years of data. That is not a countdown. And it is not a certainty. High valuations have also sat elevated for years at a stretch without any crash following at all, including a stretch just a few years ago. What this number does is describe how expensive today looks compared to history. What it has never once done, in 145 years, is predict a calendar date. This same ratio sat above its long-term average through most of the 2010s without a crash. So what actually happened to the people who just held on after 1929? The Dow Jones Industrial Average itself didn't close above its September 1929 high again until November 23rd. 1954, 25 years later, to the point. An entire generation of investors who bought stocks at the very top of that market had to wait a quarter of a century just to see the index itself get back to even. New savings still mattered along the way, but the number on the chart didn't move for a generation. The ratio doesn't know what happens next. It never has. All it has ever measured is how expensive today looks compared to every other day across 145 years of data, and how much everyone currently holding stocks already believes. Quietly, that this time really is different. History says that belief has been wrong exactly twice. It has also been right most other times. That isn't a flaw. It's the entire point. It tells you where you're standing, never where the road goes. Today, that number sits at 40.6. History says this exact level has only been reached twice before, and both times it mattered. It has never once told anyone, in advance, what happens the third time. If this was worth your time, hit like, tell me what you think in the comments, and subscribe for more money history every Monday, Wednesday, and Friday.